If you had invested 1 lakh into gold and silver at the start of 2025, it would have become 2,72,000 and 1,77,000 in just 1 year. That's 172% and 77% returns. It looks like a really good rally, but pause here. In February 2025, when hardly anyone was talking about silver, Alexander Campbell, who was the head of commodities at the world's largest hedge fund, wrote that silver could move much higher. And he was early, and clearly he was right. Silver didn't just go up after that, it ran. And now, after this massive rally, he's warning about short-term risks. That's where the story really begins. The question is not whether gold and silver have gone up, they clearly have. The real question is what happens next and what should you do as an investor? To answer that, we need to understand the 4 big forces that have started working together at the same time. I'll take you through them one by one clearly and without jargon. So by the end of this video, you can decide for yourself whether this move still has strength left or not. Factor number 1. Central banks. Central banks across the world have been buying a lot more gold. See, usually countries keep their reserves in US dollars, euros or foreign bonds. On paper, that money is theirs. But after the Russia-Ukraine war, countries realized something uncomfortable. If geopolitics goes bad or relations break down, that money may still be yours, but not in your control. Russia learned this the hard way. After the war started, Russia's billions of dollars of foreign reserves were frozen. Money was there in the account, but they couldn't use it. That moment shook the system. Instead of holding more dollars, now countries started holding more gold. Because gold is different, it doesn't sit in anyone's system and it doesn't need a bank or permission. And this is not just theory. Just last week, after the US action involving Venezuela, global markets turned nervous. When markets reopened, gold was immediately bought. This pattern is important. Whenever geopolitical tension rises, investors and central banks don't run to equities, they run to gold. The numbers show this shift clearly. Around 1,080 tons of gold was bought by central banks in 2022, 1,030 tons in 23, and an estimated 1,050 tons again in 2024. These are record level purchases, far higher than historical averages. And it's not just gold anymore. Following Russia, countries like Saudi Arabia have also begun adding silver as part of their strategic reserves. That tells you silver is no longer seen as just a volatile metal. It is starting to be viewed as strategic alongside gold. This central bank behavior is the base of the current rally. Now let's move on to the second force, the demand-supply gap. Silver is very different from gold. Understand this. Gold is mostly bought for investment and safety. Silver, on the other hand, is used every day. Today, more than half of the global silver demand comes from industry. Solar panels, AI hardware, data centers, electronics, all of these need silver. Demand is rising, but the problem is on the supply side. Silver supply is not flexible. About 70 to 80% of silver production comes by a byproduct. It is produced while mining copper, zinc, lead, or gold. So even when silver prices rise sharply, miners cannot suddenly produce much more silver. Because of this, the silver market has been in a supply deficit for the last 5 years. Now add policy risk. The US has classified silver as a critical mineral. That means governments are thinking about securing supply, not just buying at market prices. You can see the impact of this clearly. Physical silver stocks in London have been falling steadily, which, by the way, is the main global trading hub for silver. Inventories in Shanghai are at multi-year lows. This tells us the market is tight in the right world, not just on paper. That's why silver prices don't move slowly. When they move fast. And that's why silver is often called gold on steroids. It reacts to the same macro forces as gold, but with sharper moves. We saw this even in India, where around Diwali, physical shortages pushed domestic silver prices to trade at premiums of up to 15% over international rates. Now let's move on to the third force, and this one is extremely important, so stay with me. Factor number 3, debt and real rates. The developed world is sitting on very high debt, and when debt is this high, keeping interest rates high for a long time becomes dangerous. To understand why, think about one simple idea, real interest rates, which is interest rate minus inflation. This tells you whether your money is actually growing or quietly losing value. Now, when real rates are high, cash and bonds look attractive, borrowing becomes expensive, spending slows down, and risk assets come under pressure. So, central banks can't keep real rates high for long. If they try, governments are forced to borrow more money just to pay interest on old debt. That becomes a vicious cycle. The alternative is simple: keep interest rates below inflation. This is called financial repression. This means the return on your savings does not beat inflation. But for governments, this actually helps. The debt amount stays the same on the paper, but as prices and incomes rise, the real burden of debt slowly reduces. Now, what's the problem? Today, the developed countries are not growing fast enough. So, growth alone can't reduce debt. Inflation has to do the work. And in this process, cash and bonds stop feeling like truly safe assets. This is why people say money is being slowly debased. Not a collapse, just that over time you need more money to buy the same things. So what do investors do? They look for assets that can hold real value. Enter commodities and precious metals. Gold and silver don't depend on growth or credit. Their value comes from scarcity and trust. That's why the gold and silver rally of last year is telling us something simple. The system is adjusting. Inflation is being managed but not fully removed. But the story doesn't end here, because geopolitics is also playing a big role, which brings us to the last big force. Factor number 4, geopolitics. Silver is no longer just a metal that moves on demand and supply. It's becoming strategic. The US has officially classified silver as a critical mineral. That puts it in the same category as materials needed for defense, energy, and advanced technology. Once a metal enters this list, it starts influencing tariffs, industrial policy, and domestic mining priorities. At the same time, China controls roughly 60 to 70% of global silver refining. Starting January 1, China's new export licensing regime comes into effect, meaning silver exports now require explicit government approval. And here's why this is important. Because this gives China significant influence over how much silver reaches global markets. Now look at India. The RBI has announced that from April 2026, silver will be allowed as loan collateral. This is quiet but important shift. It elevates silver's financial role within the domestic system. Now India consumes around 6,000 tons of silver every year but produces only about 700 tons. That means we are heavily dependent on imports. India is now exploring sourcing silver from countries like Russia, where trade can be settled outside the dollar system. When metals start getting pulled into geopolitics, prices stop being driven only by charts. They start reflecting who controls supply, who grants access, and which currency is used to settle trade. That is a very different market from what silver was just a few years ago. And this is one reason why silver has been moving much faster than gold. So now that we understand the reasons behind the rally, let's come back to what Alexander Campbell is actually warning about. There are 3 key risks to watch from here. Risk number 1, tax-related selling. Now this one is very practical. For many global investors, selling before December 31 triggers short-term capital gains tax, which is much higher than long-term tax. So when a trade is up sharply, many investors simply wait. They don't sell in December, they wait for the new year. So what happens after that? Once the calendar turns, especially after the long holidays in the US, that delayed selling can show up together. This kind of selling does not mean investors are bearish, does not mean the story is broken. It just means people are being tax efficient. So some short-term pressure can come simply because accountants exist. Now risk number 2, stronger dollar risk. This threat to rally is coming from the US economy. US economic data has remained stronger than expected. When growth is strong, the US central bank doesn't rush to cut interest rates. So rates stay higher for longer. When that happens, 2 things follow. US bonds start paying better returns and the dollar becomes stronger. Now here's why this matters for gold and silver. They are priced in dollars. So when the dollar becomes stronger, it takes fewer dollars to buy the same gold or silver. That naturally puts short-term pressure on prices. This doesn't mean the rally is broken and it doesn't change the long-term story, but in the short term, it can slow things down. Now risk number 3, margin height. This is where many investors panic unnecessarily. So let's keep this simple. Silver futures are traded on the CME, one of the world's largest commodity exchanges. When you trade futures, you don't pay the full price of silver. You put down a margin, a small deposit, and control a much larger position. This is called leverage. Here's a simple example. If the margin is 5%, you can control 1 lakh worth of silver with just 5,000. That's 20x leverage. Now see what that means. Let's say if silver rises 5% from 1 lakh to 1 lakh 5,000, your position gains 5,000. You invested 5,000, that's a 100% return. Sounds great. But if silver falls 5% from 1 lakh to 95,000, your loss is 5,000. Your entire capital is gone. That's why margin levels matter. Low margins magnify gains, but they also magnify losses. Now here's where margin hikes come in. When the exchange raises margins, traders have to put in more money to hold the same position. If they don't have that cash, they are forced to sell. Not because they want to, but because they have to. This is exactly what happened in 2011. Back then, silver was extremely leveraged. Margins were around 4%, which meant nearly 25 times leverage. When margins were raised repeatedly in a short time, forced selling kicked in, leverage collapsed, and the rally ended sharply. That memory still scares investors. But today's situation is very different. Current silver margins are already around 17%. That means to control 1 lakh of silver, you need 17,000. Leverage is closer to 6 times, not 20 to 25 times. This is already much tighter than even the worst point of 2011. So what happens if margins are raised now? It doesn't flush out reckless speculation because excess leverage is already low. Instead, higher margins mostly affect miners, refiners, and industrial users. These players use futures to hedge risk, not to speculate. So from here, margin hikes are more likely to reduce trading liquidity, widen bid-ask spreads, and push some activity outside exchanges. But according to Alexander Campbell, they are unlikely to trigger a 2011 style crash. So yes, margin hikes can cause short-term volatility, but structurally, this is not the same setup as before. So should investors be worried? Well, not panicked, but not careless either. After rallies like this, pauses, pullbacks, and sharp swings are normal, but it's important to understand why prices might slow. Also remember, narratives can change quickly. If the US rethinks silver's status as a critical mineral, or if China eases export restriction, sentiment can shift fast. These are the things to watch. Now, before we wrap up, there is one simple indicator that you can track as an investor: the gold-silver ratio. This tells you how many ounces of silver are needed to buy 1 ounce of gold. When the ratio is high, gold is leading, markets are cautious. When the ratio falls, silver is leading. That means the risk appetite is stronger. In 2025, this ratio fell sharply from around 107 to nearly 60. That's a very big move. Historically, the ratio usually stays between 50 and 70. At around 60 today, one thing is clear: silver has already done a lot of heavy lifting. From here, two things can happen. Gold starts catching up, or silver continues, but with much higher volatility. Either way, the easy part of the rally is behind us. That doesn't mean the story is over. It means how you behave now matters more. And that's probably why someone like Campbell, who was early, is now talking about short-term risks. Not because the trend is dead, but because the market has matured. That's the real takeaway. Let me know what you are thinking in the comments. See you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.